I've said it here as I've gotten to know the crypto space. The retail community is the energy for crypto. If you don't have the energy, you can still work your way higher. But what's the difference if crypto is up or down 5% for the year? It doesn't bring the enthusiasm as a growth asset. So it needs to be in a place where the other stuff isn't working or where it's not as obvious and it's not going through. Now, the problem is when you get this kind of move higher in these things.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Jordi Visser starts with a critical observation. Crypto cannot thrive without retail participation. Unlike traditional markets, where institutional capital can steadily push prices higher, crypto depends heavily on enthusiasm, narrative, and crowd energy. If Bitcoin is only moving 5% up or down, it doesn't capture attention. It doesn't create excitement. And without that excitement, retail investors stay on the sidelines. Right now, that's exactly the problem. Crypto is not dead, but it's lacking a catalyst. Historically, Bitcoin moves in phases. It breaks a key level like 74K, then attempts to push higher, say toward $80, but fails to sustain momentum. This creates a range-bound environment where interest fades. However, Visser believes there is an underlying beta quiet accumulation happening beneath the surface, and eventually, something will trigger the next wave of attention. That something could be a macroeconomic shift, regulatory clarity, institutional inflows, or a new narrative like tokenization. Tokenization, in particular, stood out in Visser's conversations with institutional players. While retail may not be fully engaged yet, traditional finance is increasingly exploring blockchain infrastructure, especially in asset tokenization. This could become the bridge that reconnects crypto with broader markets.
I've said it here as I've gotten to know the crypto space. The retail community is the energy for crypto. If you don't have the energy, you can still work your way higher. But what's the difference if crypto is up or down 5% for the year? It doesn't bring the enthusiasm as a growth asset. So it needs to be in a place where the other stuff isn't working or where it's not as obvious and it's not going through. Now, the problem is when you get this kind of move higher in these things and it's still not participating and semis are driving everything, then it makes it hard. So I think the retail crowd is going to have to be brought in at some point. I'm not really sure what the catalyst will be at this point, but catalysts short term tend to play out. The only thing that needs to happen is there needs to be something that moves Bitcoin. We go in these stages. First it was 74. We got above 74. Now we keep pushing up to 80 and we keep falling back. I do think there's an underlying bid which will continue to push it. I talked about how I had been buying things and I bought some call options on MicroStrategy. And the reason is because I do believe that in the second half of the year, you're going to start to get money that's moving into this space. I think it's coming soon, but again, I agree with you that I hear the same thing. I didn't hear it at my conferences, but mine was a pension event, and then I went to a second conference and spoke, and this one was more for market structure people in the TradFi world. Not everyone is talking about it, but one of the topics that did come up in both events was tokenization. So I think tokenization is a place where you can get some enthusiasm about the market starting to embrace this. And I did have a conversation with a senior person at one of the organizations in crypto, and we spent most of the time talking about tokenization. I mean, this gets into the topic you just asked about. This is a broader rally than just US software companies. So when you look at the Korean stock market, it's through the roof. And part of the reason is because a lot of the things that we need, particularly on the chip side, whether it's Taiwan Semi for memory, whether it's SK Hynix or Samsung, these are companies that are listed in Asia. So this does create an opportunity for thematic ETFs that are related to things that people can't get here and put them into this. This is the reason why when I say I have a thematic portfolio, it's all around AI. So the stat I gave you that about 50% of the companies in the S&P are down for the year, 17% of my 100 names are down for the year. The ones that are all up, again, it's all the things that we've talked about. And I think people should listen to and really take into heart this supply shortage situation. You and I like to look at companies and we think about investing. You want to invest in companies where the demand is insatiable and the supply is limited. You have pricing power. it lasts for a long time as you're trying to get the supply. Yes, you have to invest money to get the CapEx, but this is why when I say that Google, Microsoft, and Amazon have a combined $1.3 trillion of a backlog. I mean, it's an enormous number. So everyone who is arguing that they're not going to get the revenues in, they have contracted agreements. Now, so did Oracle, and their stock collapsed, but it's found a bottom and now it's started to rally a little bit. I think what people need to realize is when you hear bubble, bubbles are times where supply is significantly above demand or demand is fake. The demand for AI is insatiable. Now, the price is going higher. Maybe that'll slow demand at some point. That's what usually happens. And so if there is a correction this year that knocks semis down 30, 40%, my guess it'll be from what Elon has said, which is we don't have enough power to actually light these things up. So you can buy as much of these as you want. But if you don't get the power to light up the semis, then you have all this inventory and you got to wait until the power comes. So I don't think it's going to be a debt thing. I think there'll be fears over there being too much supply relative to demand in the short term, but the demand is insatiable. It's the power that might not be insatiable. That's the part about this, that if right now you've been lucky enough to be heavily involved in the Round Hill ETF, and you've had a huge move in memory, and you've been invested in semiconductors and some of the names we've talked about here, I believe the power names, oil stocks are not priced properly for where oil is now. Chemical stocks are not priced properly. They also haven't run as much. They're steady Eddie growers. They're not going to get you this, but they're going to outperform the S&P. So the way that I'm trying to think about things is when you rotate from some of these things, if you're a momentum player, great, ride it until it starts to show signs, but then move to the other side. And the other angle is I still believe that if the market's going to sit up here and make new all-time highs, Bitcoin's going to be part of this, and so is Ethereum, and these other places are going to be in there, and I think that stuff is coming soon as well. So let's leave crypto to the side for a second, but the disruption of artificial intelligence into our world. 6 months ago, bubble was front page news every single week. Go to Google Trends. Just before Opus 4.5 came out, it was a bubble. Well, now we're seeing the revenues come in, and when you have a stock like Caterpillar, for example, so Caterpillar, it was up 10% yesterday. Their PE is now approaching 40. Those types of things don't happen for cyclical companies unless you're kind of coming out of a recession and you've had things down. Their PE is almost double NVIDIA's now. I mean, think about where we are. Semiconductor names, every single one. Most of them are in one of my thematic baskets in my portfolio. They don't stop. So this is AI. And to show you how breadth still allows people to be bearish, let's forget software, which is still near the lows. Let's forget the private equity companies, which have not budged very much. We make all-time highs in the S&P, and the median stock is 13% below its all-time highs. About half of the S&P 500 companies are up for the year, and about half are down. So unfortunately, and I literally, because I spend so many time with institutional clients and because the subscriber wall went up and I'm focused a lot, I had to come up with a term for this, because if you're invested in the S&P 500, which is what most individuals are through their financial advisors, there's a benchmark arbitrage that's happening. When you have something that we've both stolen from Elon Musk and said supersonic tsunami, it means something's moving fast and it's structural and it's just overpowering everything. So if you're invested in things that were around business cycles and the consumer, you're not doing very well. If you're in software, you're not doing very well. Even with the hyperscalers, you're not doing nearly as well as you are with all of the things related to power, all the things related to semiconductors, all the things related to servers. Are those things extended? Yes. If you look at all these charts, it's a straight line up. And that's why when you look at the S&P, it doesn't look as crazy because it actually was down for a while and then it went up. But the semiconductors, the memory names, they've just gone through the roof. So I think what people have to, in their mind, this is the early innings of this. And if you're invested in the S&P 500, you're only up 5% year to date, 5 and change year to date. If you're invested in semiconductors and you're investing in these other things, you're up between 30 and 50%. And unfortunately, for everyone that's sitting there waiting for the index to reweight, I would look into some other ways to get involved in this, at least from a minimum of a small amount, because this is not the end of this. This is still going to happen, even though we'll have a correction at some point here.
Now let's shift to the dominant force in today's market, artificial intelligence. 6 months ago, the dominant narrative was that AI was a bubble. Today, that narrative is collapsing. Why? Because the revenues are real. Companies like Microsoft, Amazon, and Google are sitting on a combined $1.3 trillion backlog. These aren't speculative projections, they are contracted revenues. Visser reframes the entire debate. A bubble happens when supply exceeds demand, or demand is fake. In AI, demand is insatiable, and supply is the constraint. This is a crucial distinction. The AI boom is not driven by hype alone. It's driven by a structural shortage. Not enough chips, not enough data centers, not enough infrastructure, and most importantly, not enough power. Yes, power. One of the biggest risks to the AI trade isn't demand slowing down, it's the inability to turn the machines on. As Elon Musk has pointed out, we may soon hit a bottleneck where we physically cannot generate enough electricity to support AI expansion. That changes everything.
The whole point of this, because there's a lot of small cap businesses that are tied into commodities, that are tied into power, that are tied into chemicals, that are tied into semiconductors even. Since we like to do some like stats on the thing, go through it, because the Russell 2000 is making all-time highs as we go through this.
Are we stat heads? Is that what we are? Like
I'm definitely, I mean, it's Kentucky Derby weekend. My paper's, going out today. So you can find it on LinkedIn and
Well, you see Jordi and I in the streets, you better call us a stat head, all right?
Remember, I was trained in handicapping. This is like a big weekend for me as someone who's gone to the Derby like about 15 years. So,
man, I love doing this every week. Go ahead.
Jeff Bezos famously said, "Your margin is my opportunity." So 6-7 companies took all of the opportunity. Your margin, they destroyed so many companies in its path, and you had concentration. When you get into the new line that I've put in, your CapEx is my opportunity.
Ooh.
Well, now you're taking up everything. And the reason is because we underinvested in manufacturing. We underinvested. So if you go back to a year ago, whatever your beliefs are and what the White House goal was, their goal was to get the middle part of the country growing again. It was to focus on AI. It was to they basically said, we're making all of the rules for this. So if you missed it, that's your own problem. Now, I would remind people, they've also been focused on crypto. So at some point by the end of this year, you're going to look back and go, oh, the administration was positive on crypto as well. Why didn't I get involved in that? So you still have things that are lagging behind that I believe are part of this bigger plan. But for AI, this involves so many companies that have been left for dead. And the semiconductors alone, it's very top heavy. So NVIDIA, when people hear semiconductors, like look at these charts, I'm like, the dollars that are going into chips, it's mainly chips. If you guys haven't heard this, you can find it, on my website, and I've written about it. But the 5-layer cake that Jensen Huang has talked about, the 3 bottom layers, energy/power, chips, and infrastructure. He's telling you what names to belong. Now, a lot of those names have been left for dead because they've been in a bear market for 15 years. It's all been about software. So the transition from software into semiconductors, into power things, into we don't have enough compute. So you can take that chip and that power thing and say, are there going to be episodic moves where these things fall 20, 30%? Of course. But do I have confidence that 5 years from now, we're going to need more compute? I have uber confidence that between humanoids coming, moving to space, we don't have enough compute. And so the chip needs are really just going to keep going. And so these companies are going to be the leaders of the future. And that's why these multiples are so high on those names. And they're becoming so low on software because software is dead. These stocks, we need them for the foreseeable future. And that's when multiples typically are high, is when you have some kind of certainty that 3 years from now, not only is the company going to be in business, which you can't say about software, but you can see there's still going to be shortages, which is where most of these things are. So it's happening. And we've been warned about this by the model providers. NVIDIA, one of their senior executives, said this week or last week at a conference, the price of compute has now reached a point where it's more expensive than a human employee. Now,
narrative violation.
Yeah. Now, what I would say is there's 2 things about this statement. Number one, for each employee, you have how many digital employees? So it doesn't mean that people aren't going to lose their jobs. It doesn't mean that they aren't going to pay for it. What it does mean is that for people like you and me using it at home, if Morgan Stanley wants to compute, they're willing to pay more money than I am. Mm-hmm. They have more money to pay. And so the price is going higher for those computes, and it's much harder for someone like me or an entrepreneur to compete on price unless, again, we don't have as many employees, unless we are able to move to open source and move in some of the Chinese models. And that's the way I've run my business. I use, and we haven't talked about this, ChatGPT 5.5 has taken over much of my Claude at this point. I didn't think that would ever happen. I thought I was in Claude for the rest of time. It stole back most of the time. Well, I think it's getting harder and harder, but I do think the arbitrage is there. It seems like forever because I wrote it over the weekend, but I published a paper Monday morning at 7:45 on power semiconductors, which was all related to a report I posted on the subscriber thing on the edge devices. And this came from last week, Texas Instruments report and Intel, where they both highlighted the edge is coming. And then Qualcomm this week, like it's coming. And when I say edge, that means autos, that means phones, computers, and humanoids. Like that part of the investment thesis is going to play. Now, that needs different semiconductors to some degree for the power side. So I wrote this thing on power semis. They're up over double digits this week. And again, this stuff goes so quickly because you're responding to something that happened in the news and you're connecting it back to these other themes. What I did was I connected it back to a report from NVIDIA over their need for data center equipment from South Korea for their new 800 volt DC power side, and they need power semis. So I don't think sell side research from the banks can keep up with this. It's very, very hard because you have to be paying attention to the news around the globe. And to get that stuff, you're getting it from X. It's not like you can read the Wall Street Journal and the stuff is in there. It's in no newspapers. It is a story by a local person in Korea that puts it out. Maybe it's in Korean. You hit the translate button, you get to see it. But you and I stay on top of this stuff. I still believe there's enough of an arbitrage, but I think retail is ahead of the game in a big way because they see this stuff and they just jump in right away.
Looking forward, Visser sees several key developments: continued AI expansion. Despite corrections, demand for compute will keep growing. Power constraints becoming central energy infrastructure may become the next major investment wave. Crypto re-emerging as part of a broader risk-on environment, especially if retail returns. Edge computing growth, AI moving into devices like phones, cars, and robotics, requiring new types